Welcome to Talk Tickers. Today, we're unpacking one of the wildest earnings stories we've seen in a while, Dayforce's Q2 2025. And what a story it is. We're talking stellar results, a totally baffling market reaction, and then a multi-billion-dollar twist that just changed the entire game.
So here's the big question we're digging into. What exactly happens when a company posts a fantastic blowout quarter and the market just kind of shrugs and scratches its head? And more importantly, what was really going on behind the curtain that almost everyone missed in those first few hours?
Okay, so first things first, let's start with the numbers, because the first act of this story is what I'm calling an undeniable beat. By pretty much every metric that matters, Dayforce didn't just meet expectations for Q2, they absolutely crushed them.
I mean, just take a look at these numbers. A 17% beat on earnings per share, that is massive. Revenue was solid too, coming in nicely ahead of expectations. But for me, the real kicker here is that adjusted EBITDA margin. It expanded by 420 basis points from last year. That's not just growth, folks. That's powerful, profitable growth. That's the good stuff.
And this right here, this is the engine behind all that success. For the third quarter in a row, their bookings, which is just a fancy way of saying future revenue, grew over 40%. This tells you that their sales machine is not just running, it is absolutely firing on all cylinders.
So you're probably asking, how are they doing it? What's the secret sauce? Well, management was super clear on this. It all comes down to their core pitch, what they call the 12-to-1 system consolidation. Think about it. Businesses are drowning in a dozen different clunky HR apps that don't talk to each other. It's a mess. Dayforce just waltzes in and replaces that entire nightmare with one single, clean platform.
And this is the before and after picture for their customers. It's a really compelling story. You go from the chaos of high costs and data spread all over the place to the calm of one single system. It's not just about making life easier for the HR department. It's about the bottom line. It's about saving cold, hard cash and getting a real return on your investment.
And their proof is right there in the execution. This isn't just a sales pitch. They are delivering big time. They just handled their largest customer launch ever. They landed a landmark deal with the government of Canada. And get this, over half of their new customers are also buying their AI assistant. On top of all that, basically no one is leaving. That 98% retention rate is rock solid. You really couldn't have scripted a better quarter operationally.
So, flawless quarter, great numbers, execution is on point, the stock should go to the moon, right? Well, not exactly. And this is where the story gets really weird.
Let's just walk through this timeline together. On August 6th, pre-market, the killer earnings report drops. So what happens when the market opens? The stock drops. It goes down almost 3%. It makes 0 sense. It clawed its way back to being basically flat by the end of the day. But still, what gives? Then you fast forward just 12 days and bam! Out of nowhere, buyout rumors send the stock soaring 26%.
So why that initial bizarre dip? Well, it turns out some people on Wall Street got hyper-focused on one tiny little detail. They called the results mixed because the company's margin guidance for the next quarter was just a hair softer than some people wanted. Can you believe it? It's the classic case of completely missing the forest for the trees.
But you know what? All that hand-wringing over a few decimal points in Q3 margin guidance, it was all just noise. It was about to become completely, totally irrelevant. Because this is where we get to the real story, the climax of this whole thing.
Because while Wall Street was busy scratching its head over the stock's weird reaction, this was happening.
Yep, $12.3 billion. The private equity giant Thoma Bravo swooped in and said, "We'll take the whole thing, thank you very much," at $70 a share. That was the real story. While the market was quibbling over next quarter's guidance, one of the smartest investors in the world saw the incredible value here and made their move.
So you gotta ask the question, right? What did a top-tier firm like Thoma Bravo see that the public market apparently missed that morning? Let's dissect this deal. Let's look at the anatomy of this acquisition. If you're a private equity investor, you are looking for durable, high-quality assets. And boy, did Dayforce check all the boxes. They have a structural advantage in AI thanks to their single data model. Their growth is not just fast, it's durable. That 98% retention is incredibly sticky. They're serving the biggest and best companies out there, but the real prize, the holy grail for a PE buyer, it's that clear, confident path to $1 billion in free cash flow. That's the jackpot.
And when you look under the hood at their sales machine, you can see why Thoma Bravo was so confident. Just look at how balanced this is. They are not a one-trick pony. A full 40% of their growth is coming from selling more to their existing customers. That's huge. And another massive chunk is coming from big system integrators bringing them deals. This is a robust, well-oiled multi-channel machine.
All right, so the deal is on the table, the company is getting acquired. What does that mean for you as an investor? Where's the play now? Well, that brings us to my favorite part, the analyst's next call.
First off, our rating here at Talk Tickers, it's a solid outperform. Now, that doesn't mean we think the stock's going to go wild from here. There's a deal price after all. But what it does mean is that this $12.3 billion buyout is a massive stamp of approval, a huge validation of the company's fundamental strength.
So how can you actually trade this? Well, the simple arbitrage play is to buy the stock and just wait to collect the difference when the deal closes at $70. Easy enough. But if you want to get a little more creative, a little more sophisticated, here's a trade structure with some really interesting asymmetry. You short some out-of-the-money puts, and then you use that income to buy some further out-of-the-money calls. Now, let me break down the logic for you.
Okay, so here's how it works. Step 1. You're making a high probability bet that this deal is going to close at $70. You sell puts way down below 65 and you collect some cash, some premium, because they are very likely to expire worthless. Step 2. You take that free money you just collected and you go buy a lottery ticket. You buy some really cheap call options with a strike price way up at 75 or 80. Why would you do that? Because in the small chance that another company comes over the top with a higher bid, those cheap call options could absolutely explode in value. It's a way to get a free shot at a massive payday if a bidding war breaks out.
You know, this whole saga is just a fantastic lesson in looking past all the short-term noise to see the long-term value. Okay, and of course, I have to say it, this is not financial advice. Please always do your own research. But it really makes you wonder, doesn't it? What other great companies are out there right now that the market is mispricing just because it's focused on the next 3 months instead of the next 10 years?